3, Concepts of Home Ownership.
Page 26 opens up our discussion of home ownership, and on page 26 and 27 what we're really showing you is that in addition to single-family homes, there are many other types of dwelling units that are purposed for residential use. Obviously, commercial real estate is a whole other area that we could talk about, but these two pages primarily talk about individuals looking for residential types of dwellings, and the types that are there are apartment buildings and condominiums, cooperatives, planned unit developments, retirement communities, and converted use structures. Converted use might be where they took a large loft area and what at one time would have been used for maybe industrial or warehousing kinds of uses and repurposed it for loft units, upscale, if you will, residential units. The manufactured housing does include mobile homes. Manufactured housing is any housing that was the components of which were built off-site at a factory and then shipped to the vacant parcel, and they're assembled into a house. In fact, years ago, Sears Roebuck actually pioneered manufactured housing. You could actually buy a house from Sears on a catalog, and they would drop it off at your lot, and you would assemble it there at the site. Mobile homes are considered manufactured housing, but mobile homes aren't really considered real estate. They might be used for residential uses, but they're really classified as personal property and not as real property. The intent of mobile homes is that their intention is to be moved and not fixed in one location, as real estate typically is described. Modular homes and timeshares are also considered types of residential units for individuals and individual dwellings, and these may also be areas that you, once you're licensed, you may even want to specialize in these areas. Home ownership in the United States is critical to our gross national product of our country and to the health, welfare, and expansion of our economy. So on the federal level, state levels, and local levels, trying to stimulate, maintain, encourage, and increase housing for individuals is very important, and the key to doing that is housing affordability. So housing affordability is at the center of having a healthy, robust real estate market that is important to our economy, certainly important to our real estate professionals who make a living in the residential real estate field. Housing affordability, your book talks a little bit about rent versus buy. Basically what they're saying is that you've got to live somewhere, and when you're making these decisions of whether you should be renting or whether you should be buying, these are the kinds of considerations that you're going to be thinking about. The first is you're going to be asking yourself, where am I working? How long am I going to be here? Am I ready to put down roots? Do I have stability in my work and in my where the area I'm going to be that I want to live in? Will I be living in the same area I'm working in? So you'll look at that as consideration. Obviously, if you are going to be a bit nomadic, or you don't have plans to stay in an area over a year or 2 or 3 year period of time, you're probably going to be thinking more of renting than putting down roots and purchasing something. Your financial situation is going to be very important to you. How much money you make, what your debts are, what your credit scores are, what kinds of loans you might have to be repaying. Right now, a big issue with housing affordability are the student loans. We have this young generation that is now leaving college and going into the workaday world, and the real estate industry has a real concern that their effect of the student loans that these young people have is going to affect their ability to purchase property, and it probably will. So it's a real consideration. So financial and your financial strength, your financial condition, your financial outlook is going to be an important determination whether or not you rent something or whether you purchase something. housing affordability factors, what affects housing affordability, your ability to buy something, comes down to three factors basically. The price of a median home in your area, certainly mortgage interest rates at the time you're ready to make a purchase, as well as any down payment you might have. Obviously, the higher the down payment you need, the more difficult it is to purchase something because it takes a lot more money to do that. However, the more down payment you have, typically your mortgage interest rates will be a little more attractive with higher down payments. So mortgage interest rates and down payments are the two key ingredients to helping housing affordability for most people as far as their rent versus buy decisions. And of course, we might look at the tax consequences. Tax consequences may, in fact, be so important to you that purchasing and getting the capital gains treatment that you have when you purchase property, as well as the deductibility of your home loan interest, as well as your annual property taxes, it should be a real consideration. So as you're making the rent versus buy decision, one of the things you'll look at is, if I do buy something, even though I might be stretching myself and maybe my mortgage payments may be higher than my rental payments, and obviously I've got to come up with a down payment, and obviously I'm making a decision that I'm going to be living in this area for a couple of years, but you'll also look at the tax consequences that will accrue to you as a homeowner versus a renter. As it concerns affordability, you as a real estate agent really have only one real concern as far as affordability that you're going to be involved with, and that's knowing what PITI stands for. We talked about this earlier, and we talked about front end and back end ratios, but just to put a little sharper point on it, when you're working with your buyers and looking for properties for them, you can do your own thumbnail analysis of PITI, what it's going to cost them to be in a particular property, and whether or not that's going to meet their ability to pay. So PITI stands for principal, interest. Of course, when they borrow monies, their mortgage payment is going to be PI, principal and interest. Then to their mortgage payment, that which they have to pay back on the loan that they're going to take, both in principal, the amount of the loan itself, plus the interest that was going to accrue on the loan that they're going to have, breaks out into a monthly payment, which we call PI. The principal interest, if the borrower pays that amount over the period of time, the 30 or 35 or 40 years that they're taking the loan out, that will the PI portion will completely eliminate and pay off the principal that they borrowed plus the interest. So PI, to that we're going to add taxes and insurance. Typically 1/12 of the real estate taxes and 1/12 of the insurance is held in an escrow account, of which the will be maintained through payments added to their monthly PI payments. So we have PITI is basically your monthly payment you're going to make every month, Mr. Borrower, to extinguish your debt, plus to have reserves for your property taxes and for your property insurance. It will be paid annually. Note that you may be adding additional monthly expenses to the PITI, which might include things like homeowners association fees, other association fees. Perhaps it may be a condominium, so you've got your condo fees, if you want to call them condo fees, same as the homeowners association fees. FHA or mortgage insurance premiums that might also be added to the monthly payments depending on the kind of loan that's being taken out, maybe private mortgage insurance, those kinds of things. So in order to get the monthly nut that the borrower has to pay each month to see if they can afford the property they want to buy, in addition to PITI, we may be adding these additional amounts. Many people are interested in the different investment considerations that individuals might be thinking about either purchasing single-family property that they're going to occupy, or perhaps even investment real estate. As a real estate salesperson, you really should understand the advantages that accrue to individuals that own real estate and live in it, as well as people that purchase real estate for investment purposes. You need to have a working understanding of that. So we're going to give you just kind of a brief overview to this. And the other reason you may want to know it, particularly for residential, is as you're dealing with prospective purchasers, or perhaps maybe even tenants that you want to convert over to purchasing single-family properties, condos, townhouses, or single-family homes. One of the great advantages that you'll want to be able to explain to them are the different investment opportunities that are accruing to them as a result, and investment advantages that are accruing to them as a result of them owning residential real estate. For instance, as an owner of real estate, you have annual, monthly, perhaps daily increases in the property value. And yes, I know over the last couple of years maybe some of our properties haven't, but they're all starting to gain momentum now. So real estate has generally gained value and depreciated over all these years. And we had a little hiccup over the last 3 or 4 years, but I think that's an anomaly. And we see values of real estate picking right back up and increasing. So when you own real estate, when you purchase real estate, you should be getting, if not monthly, annual increases to the property value. Likewise, when you purchase real estate, you can borrow money and use that real estate as collateral to move into a property. You don't have to give it up. You can actually move into the thing that you're mortgaging. And you can take the mortgage debt that you have and pay that off every month. And as you're making your, if you will, interest payments on your mortgage debt, you're also reducing what you owe. So if you take the increase in property value that's happening, let's say monthly, and if you take your mortgage debt reduction, because you're paying off your mortgage every month, the mortgage balance every month, we have a special thing called equity that accrues to people that own real estate. And equity is basically what you walk away with your pocket when you sell the property. Equity isn't what the property's worth. Equity isn't what you owe on the property. Equity is the difference. It's, as I say, what you end up with at the end of the day owning real estate, and when you finally sell it and pay all your debts off on the property, that money you put in your pocket is called equity. Another advantage to real estate would be income tax advantages, and we're going to talk about those that accrue to the single-family residential owner, some great income tax advantages. Some individuals will purchase real estate for investment purposes, and primarily for investment rental income they might get, whether it be residential property, multifamily properties, single-family condos, or perhaps even commercial types of properties. The investor primarily is looking for cash flow from rental income. So that's one of the advantages of owning real estate is from an investment standpoint. There is some cash flow that you get from rent that your tenants are paying you. You also get annual depreciation deductions from your net income. So you're able to, with help with your tax man, to take the value of the depreciation of that's affecting the property every month, every year, your annual depreciation, and you're able to subtract that from your annual net income, so essentially you're sheltering some income from the tax man by taking these, quote, depreciation deductions. We'll talk about this more in another slide. And then, of course, there's capital gains treatment. Again, we'll talk about this in the next couple slides. But basically, capital gains treatment is a way that when you sell investment property, you're able to shelter some of the taxes due if, in fact, you engage in a 1031 exchange versus just sell your investment property outright and take all the proceeds from it. It may be possible you may have a desire to, if you will, trade down, and therefore with your investment property, can't do this with residential property that you are owner-occupied with, but with investment property, you're able to shelter some of that gain that you've made from the federal tax man. Capital gains taxes, you can think of capital gains as being the profit earned on the sale of real estate. We buy property, and over the years it appreciates, typically appreciates over years, and when we go to sell it, we've sold it for a profit. Uncle Sam comes along and says, we're glad to hear that. Since you have an item that's considered an appreciable item that has a gain to it, which is what real estate does, we're going to tax you on your profit, Mr. Homeowner. Owners, when they pay their capital gains tax, pay at their ordinary income tax rate. If this is investment property, capital gains is computed on two rates. One's a federal plus a state rate. The Illinois rate is 3%. The federal capital gains rate is 15%. So when we compute the profit, we take our ordinary income rate, whatever it is based on our family income for owners. For investors, we take it at the federal rates and the state rates, which are set by law. However, because it's an individual residence and because we don't want to be too harsh to our individual citizens, we allow exemptions on our capital gains. If you're single, it's $250,000 exemption, pretty nice exemption. If you're married, it's a $500,000 tax-free exemption. So if we go, and the rule, of course, is you have to have living in that property 2 of the last 5 years to qualify. So as long as you're there for 2 of the last 5 years, you can continue to qualify for these single or these married exemptions from capital gains. So with individuals, we want to know that $250,000, that $500,000 exemption that individuals can claim. Must know that. And then on commercial property, as far as 1031 exchanges, which is another option, just to understand the basis of this, I don't think you're going to get many questions on 1031 exchanges. What I do want you to know about 1031 exchanges is not that you're declaring any kind of forgiveness on your capital gain with these investment properties. You are just deferring them for a later date. So they're not excluded like you would be with for individuals. And a 1031 exchange might work something like this. You had a property, you bought it for $500,000, and you sold it for $1 million. So our selling price is $1 million for this property with a 5% commission. Here's what happens with that investment property. We've earned a profit of $500,000. We have some capital expenses, including a commission. We get to subtract that from our profit. So our taxable profit is $339,000. This is commercial property. There's no exemptions like there are for the individuals. So we've got two choices. On our taxable profit, we either pay the capital gains on it and we're done with it, which is $61,020, or there's another option. We can defer our capital gain to a later time and pay taxes then. If we defer it, we're going to buy a new building and we'll declare a 1031 exchange. What's going to be important is whether the new building is more expensive or less expensive than the $1 million building that we're selling. So we're selling this $1 million building. We're going to exchange a $1 million building. If we exchange it for a higher price building, all of the capital gains is deferred for a later date. No taxes due. If we exchange it for a building of lower price, in this case $900,000, remember our building sold for $1 million, then we pay the difference in the tax due, which is $18,000 of the boot of the $100,000. So we're going to pay $18,000 in tax, which is at 15 and 3% of the $100,000 quote gain that we have. So that will be due. The rest of it is deferred. Don't have to know these exchange rules, but you should know part of the rules is you have to declare your intent for a 1031 exchange within 180 days after you've sold property. You can select a qualified intermediary, three possible replacement. You have to have select 3 possible replacement properties and who the intermediary is going to be, who's going to be holding this within 45 days. Then you've got an additional 35 days to close on the new building. Again, I don't think you have to know any of these exchange rules, but they're in your book and hopefully you'll understand a little bit better. So that's why I've got the white thing there. Probably not, you don't need to know that. Homeowners insurance, there's a basic form of insurance that most people have. You won't really be asked too much about homeowners insurance, but you should know, what coverages that it has with your basic form. Maybe take a quick peek on that on page 28. You might want to know the word subrogation. Subrogation says if you have a loss as a property owner and I'm your insurance company, I'm going to pay you off, but then I have the right to go and sue whoever created that loss for, quote, you and me. That's what subrogation means. I get to settle with you, stand in your shoes, and then I have the remedies that were afforded you. I have them for me to go after whoever created the loss that I eventually paid on your behalf. A co-insurance clause, you should know that your insurance policy should have a co-insurance clause, which means every year you're probably paying more in insurance premiums than you did the year before. Why? Because typically every year your property appreciates in value. Despite our market conditions, there are still properties appreciating in value somewhere in the world, I suppose. Because they're appreciating in value, you want to make sure that you always are insured for at least 80% of the replacement cost of the dwelling. As long as you're insured for the 80% of the replacement cost of the property, in other words, you're paying your insurance premium based on 80% of the replacement cost, and every year that's probably going up. The good thing about that is that if you suffer a loss, there'll be no deduction of depreciation. The insurance company pays you the full amount of your loss and doesn't shortchange you with this thing called depreciation. So that's what the co-insurance clause is. It says every year, Mr. Insurance Owner, we're going to increase your rates if your property goes up in value to keep you at that 80% minimum coverage level. Federal flood insurance. If you're in a federal floodplain area, which means you're in an area that the U.S. Army or Corps of Engineers says tends to flood a lot, if you purchase a house in that area, before you can get a loan on that property, you're going to have to buy this separate federal flood insurance to protect you and to protect the lender if you're in a floodplain area. So whenever you list property, you want to make sure or ask the sellers if they know if they're in a floodplain or flood hazard area. That must be disclosed to prospective purchasers, because the lender is going to require this separate floodplain insurance before they'll give you a loan on the property.